In our Cape Town studio is Paul Hutchinson. He's Head of Retail Business Development at Cadiz Asset Management. And what we're doing is talking here about income investing. Morning to you, Paul. Perhaps the way to get this going,
Morning, David.
From you in Cape Town to us in Joburg, is to talk about conservative investors who in the days of relatively high interest rates were happy to put their money in money market or other similar places, and they'd make a reasonable return. Now that's changed. Interest rates have been chronically lower, and they've had to make choices, had to get out of there, otherwise they fall behind. So set out the problem for us and then we can talk about some of the solutions.
Thank you, David. Yes, very simply, until as recently as a few years ago, investors, conservative investors who made use of money market type investments were able to earn an annual return north of 10%. This at a time when inflation was around 6 or 7%, so they earned a real return. And yes, they had a tax effect on that real return, but they were invested in low-risk, liquid investments. As you'll be aware, South Africa has gone through a secular decline in interest rates, and now these investors, these self-same investors, are faced with negative real returns. On a one-year basis, they're currently earning just less than 6%. Inflation is very sticky, north of 6%. So negative real returns. The implications of this are that the purchasing power of their money is decreasing through time. And this presents what I've termed the income dilemma. And that dilemma simply is that they now need to consider giving something up. And this is the challenge that they and their financial advisors are faced with.
Paul, so what are the alternatives for someone who's hoping to keep pace with inflation?
Given the current environment, it is a very difficult place to be investing. The challenges that they're faced with are that they have four key questions to answer, and these are the issues that they need to consider, and one of which they need to give up. So if they want to continue to earn real returns through time, they need to accept that they are going to have to take on more risk and potentially lock their money away for a longer period. So they're moving up the risk curve, and potentially they're moving away from assets in which they can have immediate access to their money. And these are the issues that they're going to have to consider. Within that spectrum, many investors have moved from the money market to what are termed enhanced income type funds. And here the payoff is potentially higher real returns through time. And what they lose is immediate access to their money. Yes, they continue to be liquid, but they need to be taking a longer term view. These enhanced income investments remain relatively tax inefficient in that the majority of the return is interest in nature, and as we know, it is the highest taxed asset class.
Paul, what about fees? When people have been sitting in one area of investment, they get accustomed to the fee environment. If there is one, sometimes you don't have to pay fees. And some of the things that you're suggesting they have to move into, they might overlook the fee aspect in terms of diminishing returns.
Very definitely, and what investors need to consider is the after fee return that they are getting. So money market unit trust funds, by way of example, are relatively cheap in that you're paying an annual management fee from as low as 15 basis points up to 50 basis points per annum excluding VAT. As soon as you move into multi-asset type investments, so the annual management fee for managing those assets does go up. So it's very, very important that clients or investors consider the after fee return that they're likely to get into the future when making this decision.
Paul, some of the alternatives that you mentioned was that investors have to accept that they need to take on more risks. But is this applicable to everyone? So if I'm a retiree or if I'm nearing retirement, how much more risk can I take?
This is a key question, and part of the answer is how long do you think you're going to continue to live for? So many people underestimate at retirement how long they're going to continue to live. And we often see quotes of South Africans' life expectancy, I'm going to estimate, at about 55. But that's life expectancy on birth. Life expectancy in your 50s can be a further 30 years. So for investors who immediately de-risk their portfolios on retirement by going to cash, run the risk of their assets running out before their life runs out. It's quite a harsh way of saying it, but it's a significant risk that investors bring upon themselves is life expectancy risk by de-risking their portfolio into money market type assets immediately on retirement. They are going to recognize a need to own riskier assets, being property and equity, for an extended period of time, given that they might live until 90 and not be in an income-producing state.
Yeah, if your money runs out, you run to your children and they run away from you, so you've got to be careful. Thanks to Paul Hutchinson, he's Head of Retail Business Development at Cadiz Asset Management.